new to the stock market but still not making any profit, there's a good chance you're unknowingly making some serious mistakes that 90% of beginners make. And these mistakes are so dangerous that many people end up losing their hard-earned money in the market. But if you watch this video until the end, believe me, you'll already be far ahead of the 90% of traders who keep losing money in the market year after year. In this video, I'm going to show you the top 5 dangerous mistakes beginners must avoid. And if you manage to stay away from these mistakes, you can become a profitable investor. Because at the end of the day, this is simply a game of consistency. So make sure you watch this video until the end, because the last mistake is the most dangerous one. Let's start. Mistake number 1. Investing without a clear strategy. One of the biggest mistakes beginners make is entering the stock market without a clear strategy. Most people see a trending stock, hear someone say, "This stock is going to explode," and immediately hit the buy button without having any real plan. But professional investors never invest like that. Before entering a trade, they already know 3 things: when they will buy, when they will sell, and how much risk they are willing to take. Imagine 2 people starting their investing journey on the same day. The first person buys random stocks based on hype. The second person spends time researching companies, understanding the business, and building a clear plan. 6 months later, the first person says, "Stock market is just gambling." Meanwhile, the second person is quietly building profits. The difference isn't luck. The difference is strategy. So, the next time you're about to buy a stock, pause for a moment and ask yourself one simple question. If this stock drops 20%, would I still confidently hold it? If the answer isn't clear, the strategy probably isn't clear either. Mistake number 2. Following the crowd. In the stock market, there's a rule smart investors understand very well. When everyone is excited, professionals become cautious. But beginners usually do the exact opposite. When a stock starts trending on social media, when everyone begins talking about it, when news channels start calling it the next big opportunity, that's exactly when most beginners jump in. And ironically, that's often the most dangerous moment to enter. Because by the time everyone is talking about a stock, much of the move may already be over. Then suddenly the price reverses. The same people who were shouting, "This stock is going to the moon," begin panic selling. Professional investors don't chase the crowd. They observe the crowd. Next time you see a stock going viral online, instead of rushing in, pause for a moment and simply watch how the market behaves. You'll start noticing patterns most beginners completely miss. Mistake number 3. Ignoring risk management. Most beginners focus on only one thing: profit. But professional investors focus on something even more important first: risk. Experienced traders understand that not every trade will be a winner. That's why they decide how much they're willing to lose before they even think about how much they can gain. Imagine 2 traders. The first trader risks 30 to 40% of their capital on a single trade. The second trader risks only 2 to 3% per trade. After a few bad trades, could lose most of their account. The second trader is still calm, still in the game, and still ready for the next opportunity. That's why experienced investors follow one simple rule: protect the capital. Opportunities will always come. But if your capital disappears, the game ends immediately. Mistake number 4. Letting emotions control decisions. The stock market may look like a numbers game, but in reality, it's mostly a psychology. 2 emotions dominate the market: fear and greed. When prices rise, people feel greedy and buy late. When prices fall, people feel fear and sell early. And this cycle keeps repeating again and again. Professional investors break this cycle by replacing emotions with systems. They follow rules. They stick to their strategy. They don't react emotionally to every small price movement. The next time you buy a stock and start feeling nervous the moment the price drops slightly, pause for a second. Ask yourself, did I make this decision based on logic or excitement? That one question alone can save you from many expensive mistakes. Mistake number 5. Thinking short-term instead of long-term. Most beginners ask one question: how much profit can this stock make next week? Professional investors ask a completely different question: where could this company be in the next 5 to 10 years? Real wealth in the stock market is created through time and compounding. At first, compounding feels slow, but over time, it starts accelerating. And many investors never reach that stage simply because they lose patience too early. Try something simple. Look at the 10-year chart of strong companies. You'll notice there were many ups and downs along the way, but the long-term direction was clearly upward. That's why experienced investors don't treat the market like a daily game. They treat it like a long-term wealth machine.